Good morning, good afternoon, good evening. It's June 15, Thursday, 6:12 p.m.
June 15 na.
Yes, it's episode 80, Overbought Market. By the way, this is Mark Yu,
And this is Wawi Santos.
and welcome to episode 80, Overbought Market. So why I say so? Because if we're gonna take a look at the what do you call this? The relative strength index, which indicates if a market is overbought or not. Usually, if it's
Mhm.
above 70 points or 60 and above or 30. I think it's 60, right, Wowie?
Yeah, above 60. When it's 80, you know it's really, really overbought.
Yes. So if we're gonna take a look at the S&P's chart for at least since the start of the year, it's been going up. Uh, from low 3,800, we've been in that range since we broke it on May.
Mm-hmm.
Then we haven't looked back. We're now at 4,425,
Mm-hmm.
which is pretty good. I mean, it's sending a lot of stocks, big major companies to all-time highs, like the likes of Apple and Oracle, even Nvidia, right, Wabi?
Yeah, I think it's self-feeding itself because analysts are saying, you know, that these large large cap companies are gonna be ramping up, they're gonna outperform, they're gonna perform. So it's just feeding itself, and then FOMO with it is just pushing it up higher.
Yep. As you could recall, for those listeners who have been following us, we have predicted that there's going to be a FOMO rally that's going to come up shortly. This was about 2 weeks ago. And now looks like they've been following the trend. Even in sentiment surveys like the ones that we take a look at on a weekly basis, the AAII sentiment survey, if whether what the investors think, where will the market be, up or down or neutral in the following 6 months. So as of yesterday, there is ever increasing bullish investors. And believe it or not, Wowie, we have actually pierced through the historical average of 37.5
Woo,
a week ago. So,
we're in the
uh,
40s now.
yeah, we're currently at 45.2 in terms of bullishness. We haven't seen this since more than a year, more
Yeah,
than a year and a half, actually. Because we usually have been seeing 29, 27, even high teens like 19, 18, 17. But right now, from May 31st to June 7th, the first week of June, it skyrocketed in terms of bullishness. From 29, it jumped to 44.5. That's a huge jump in terms of optimism, bullishness among stock market investors. How about you, Wawi? Do you feel bullish right now?
well, I'm still on the cautious side
Yeah.
because the Fed is not done with their Fed rate hikes, and there was confusing news yesterday. I thought they were gonna raise, and then uh, early this morning I found out that they did indeed pause, but they
Mm.
indicated that they're gonna raise the interest rates for a couple more months.
Yep. So they're just gonna. I think I heard what do you call this? What's his name? Federal Chair Powell said that he didn't intend it, but he did say the word skip. But he's still wanting to do more rate hikes in the near future.
Mhm.
And if we're gonna take a look at the fear and greed index, we are now at extreme greed, 81 points. We are already at the extreme greed territory since last Friday, but it even went higher. And if you're gonna take a look at the chart, it's like it's imitating what the S&P 500 is doing. As the index is going up, optimism goes up as well. And look at this 125-day moving market momentum's chart.
Woo.
It's just skyrocketed way up there. This is the S&P 500 in contrast to 125-day. And volume. So we're seeing a little bit more volume. Some more buying among investors.
Mhm.
So this is a supported uptrend, looks like, at this point of time. I think it's one way of seeing if the market has some legs to it. So currently right now I think there is some, at least as of yesterday. Put and call options, oh my gosh, it's just collapsed. Nobody's buying put options right now. It's a total inverse of what we had experienced a year ago, even until last May. Right
Mhm.
now nobody is buying put options.
Yeah, it's risk on right now.
Risk on indeed. And for the volatility for the past week, well, believe it or not, volatility went up 6.3% in the S&P 500, as well
It
as for
went
the
up
Nasdaq.
yesterday,
Mm-hmm.
like 19 yesterday, because of, I guess, the confusing signal from Powell. And
Yeah,
then it went down again today after clarification.
right. So the volatility for Nasdaq and S&P 500 are definitely up. But if you take a look at the S&P 500 for the past week, it's also up 2.8%. Well, that's kind of weird. Usually, if we see volatility up, usually for the indices, they're both down. But also, Nasdaq is up 3.53%. Wow.
I don't
So,
know about the futures, but we'll see.
yeah,
Trending.
the contrarian move is to go down, but looks like now nobody's going down at this point.
Yeah,
For
it's a broad sector rally today.
for sure. And for the past week, each and every sector except for energy went to green, went positive.
Mhm.
Technology is 5.47% higher, followed by cyclicals, communication services, industrials. Energy is flat, 0% for the past 5 days, followed by utilities, real estate. And if we're going to take a look at the year to date, of course, number one performing sector is technology, worst performing sector is energy. So this is the move index, which is provided by Yahoo Finance. So this is a good gauge. If there is trouble in the bond sector, where a lot of money also piles in, a lot of smart and distinguished investors pile their money in the bond market. If this goes up, it means that there's some trouble brewing that the stock market hasn't noticed. So recalling, volatility is actually up. But we're going to take a look at the move index. It's actually just a little bit up. Well, it's ways down from back in March.
Well, there's some signals that it may be down tomorrow,
Hmm.
with the 10
Yeah,
year yield going down
yeah, there we go.
uh,
I think this is a better view. So,
7 points,
since this,
7 basis points today.
right. And for the past 5 days, it's actually down from 115 to 114.37. And if we're going to take a look at this since the start of the year, back when the banks were collapsing left and right back in mid-March, the move index was shooting up higher, even at 180s at one point. But right now we're down to 107. So not a lot of fear right now, even in the bond market. And if anything, if this is of any help, because they only update it, I guess, once a month or monthly, the Federal Reserve yield curve indicator for the recession. As of May, it's still on the negative territory, and the probability of recession is still in the highest, not seen since 1980s. So we are already have a probability of US recession in 12 months, almost guaranteed at this point of time. So who are we gonna choose to be conservative and go all in cash or ignore the details, ignore the predictions, and just stay invested?
Well, we've been predicting for things to go into recession, uh, based on the economic indicators that I am seeing.
Right,
It is likely that it would happen, and especially when the interest rates are being kept up. Um, but it may be a short one.
right. Well, we'll see. And in terms of fund flows, following where the money goes, so this is updated as of June 9. US stock or equity funds post biggest weekly outflow in 10 weeks. So a lot of money came out of US stock market funds, interestingly. It says here, investors are worried about rising inflation and economic slowdown. So the upcoming release of US inflation data next week, this is this week, added to caution as it could potentially influence Federal Reserve on the pace of rate hikes. Nearly 16 billion was pulled out from US stock market, its biggest net selling since March 29 of this year. A lot of money came out from large and mid cap. However, small cap funds saw net inflows, 1.15 billion. Tech sector was the largest outflow, 1.31. So with this a lot of outflow, they definitely had missed out because for the past week alone, technology was still the best performing sector. So
Mhm.
those who got afraid and pulled out their money from tech definitely missed out on this one. Again, may fuel their FOMO status or condition, mental state right now. Meanwhile, money market received inflows of 19.8 billion net buyers for the seventh consecutive week. So still a lot of money plowing into money market, the safe haven. Even bond funds didn't escape. A lot of money has been withdrawn. 561 million last week. 5 consecutive weeks
Of
uh,
inflows.
of inflows. After the 5 consecutive week, finally, at least half a billion came out of bond funds. So, yep, interesting information there. A lot of investors bailed out last week and missed the rally this past 5 days. Actually,
There's
I
definitely a
noticed.
lot of trading going on this
Mhm.
last 2 days.
Yeah, and actually, I noticed that my Amazon investment, which has done poorly since the
Mhm.
start of the year, is only now down 2.6%.
Yeah, Amazon is starting to go up higher.
Yep,
Uh,
it's
yeah,
up from 126.
a lot of these online retailers are doing a spin on the way they sell things. I think Walmart, for one, is putting in some brand names and higher priced clothing uh, brands into their stores.
Hmm.
So they're trying to lure in more profit uh, into their sales by putting brand names in their market. Now, Amazon is for small items, they're being challenged by Temu, but they don't see Temu as really a competition at
Right.
this time.
Hmm. Well, it's yet to be seen, but definitely numbers are showing Temu is gaining a lot of traction. Even I saw, I think it's Bloomberg or some other financial article published that Temu has already surpassed Shein as in
Mhm.
terms of traffic and merchandise being sold. So they're quickly gaining momentum at this point in time.
Strong marketing power on that. on that company.
Hmm.
Now
So,
Amazon as a
mhm,
share price has been improving just recently.
yeah, yeah, I'm surprised it turned positive. Well, still negative, down 2.6%, but it's the only FANG group in my portfolio that's negative for this year. All the rest are good, especially Nvidia, which I sold a bunch too early. I should have kept on it, but that's fine.
Well, I'm keeping my 15 shares. This is the only thing that's unstoppable is Nvidia. No matter the situation of the market, it just keeps rallying for some reason.
Yep, FOMO. So
Yes.
yeah, according to yesterday's hike, oh well, yesterday was a pause, according to Reserve Chairman Powell. According to Reuters, the central bank left rates unchanged on Wednesday, as widely expected, but surprised some markets by signaling that borrowing costs will likely increase another half a percentage point by the end of this year, as it reacts to a still strong economy and a slower decline in inflation. Traders' expectations for peak rates moved higher after the announcements. So I guess why we just need to anticipate that there would be another 50 basis points
Mhm.
somewhere in between from now till the end of the year.
Yes. And then, he said that he's gonna raise it moderately
Mm.
as needed, more
Yeah.
moderate pace of increase.
Huh. So according to this expert, Chief Investment Officer Wilshire, Mr. Emmanuel, Josh Emmanuel, he said that it is dangerous to be underweight equities or not to be invested in stocks, which have rallied on dissipating recession fears and excitement over developments in AI. As a result, he is staying away from assets that could be hit hard if market stress suddenly increase, such as small cap stocks. So maybe the one sector that would be hit hard if we get a lot of, bankruptcies are the small caps, small companies, which will have harder access to cash from banks.
Mhm. Yeah, that makes sense.
Okay, so here's another one. This is the Bond King, Jeffrey Gundlach, Double Line CEO. He said that if the Fed follows the path that they're talking about, they are going to break something. He recommended increasing allocations to high quality bonds while reducing stock holdings, noting that rising yields have made bonds cheaper and more attractive to income seeking investors. So I'm not sure. I don't have any much more of a bond exposure at this point. But if anything, I'm looking at this yield provided by CNBC. US Treasury is 6 month Treasury is 5.3% yielding. It's a good indicator. It's a good amount. 5.3% to park your money there and do nothing and earn interest.
Mhm.
Whereas last year I think it was 0%. So it's a good amount of yield at this point.
Or put it on a CD
Uh-huh.
for near the same yield.
I think there's a website for certificate deposit. CD rate lookup, CD rate search. Nah,
Mhm.
I I had a website somewhere. I was looking at it and it helps once you put your zip code, you can actually see among your area who provides the best deal. But
Yeah.
I'll share it next time when I pull it up.
Yeah, right now they're showing like the 6 month CDs. and some banks are 5.4%,
Mhm.
and the 1 year CDs are 5.45. It kind of matches the bond yields,
Yeah, and actually
short-term bond yields.
it's near what the Federal Reserve is trying. So fresh quarterly forecast showed borrowing costs to 5.6% by year end, whereas right now we're at 5 to 5.25. So I think the market is just, trying to be at par or equal to where the Federal Reserve is at this point in time, which is good. They're
Mhm.
giving all the yield to their customers, satisfying their demand for passive income.
And
So,
stabilizing the deposits in these small banks that are
mhm,
offering these higher CD rates.
right, preventing any bank run. So yeah, this is the chart from what is it? Econometrics, which is good. So you could tell the Fed's fight against inflation is actually working. So we started above 8.5%, and it's been slowly trending down. We're now at 4%. So actually the Fed is winning here, despite
Mhm.
the earlier bankruptcies of those three big banks.
Yeah, I think it was Neil Azus that said that we might reach 3% in December this year
Mhm.
with Rare View Capital, CIO of Rare View Capital.
Right. So some
We're
thoughts.
just we're just a percentage point away from it, looks like.
Uh-huh. Yep. So just some thoughts from fund managers around the United States. They are not buying a broad bull. They remain underweight stocks with sentiment low. This is 2 days ago, June 13th. So
When did that
interestingly,
change?
yeah, despite the incredible uptick in bullish sentiment in AAII, a lot of fund managers are not reflecting that. The pain trade. June Global Fund Manager Survey of 285 panelists with 764 billion in assets under management found that respondents are still overall underweight stocks, although they are long tech. Fund managers are also long investment grade bonds, the most in the last 8 years. Cash levels are down to 5.1%, the lowest since 2022. So a lot of these fund managers are ready to deploy, I guess, but still being conservative. I'll be on mute for a second, Maui. Give me one
Okay.
second.
Well, looks like on a macro level, managers are expecting the start of a soft recession, which is what I'm predicting. Punting the start of Fed cuts to Q4, Q1. Inflation expectations have fallen to a 28-year low. A net 87% of FMS investors expect lower global CPI in the next 12 months, up 3 percentage points month over month. So a broad measure of FMS sentiment based on cash positions, equity allocations, and economic growth expectations remains stubbornly low. And AI, baby bubble, FOMO, technical, and so on can lift this. But fundamentally, FMS asset allocators saying we need a meaningful downward surprise to rates and or a meaningful upward surprise to growth or no recession.
So it looks like sorry about that. Well, we're back in FOMO mode, right?
Yes.
Yeah. If we're gonna take a look at the chart here provided by Bank of America, yep, their fund managers are definitely a lot bearish compared to regular investors out there.
Well, the financial sector has been hit hard by the economy, and the quantitative tightening. So you may find some bargains here on the financial sector
Mm-hmm.
up to now.
And if anything, this is a Bloomberg article published about a week ago saying Wall Street's once hot trades of 2023 are unraveling in markets. Bets on Japanese yen, China equities backfire. Um, so the once hot trades of this year are falling apart.
Hmm.
Nearly halfway to the year, consensus bets are losing big time as the US economy defies the recession bears. The AI craze heats up, and more. So, including misfiring strategies, including selling big tech stocks, ignoring the US dollar, and buying into promise of emerging market equities such as China emerging from COVID lockdowns have been losing trade. Instead, US growth stocks are on the cusp of a full-blown melt-up, while China stocks sink into a bear market.
Yeah,
That we felt on our Alibaba stake for sure. I think Alibaba, at least, I don't know, where it's not $92 today. Yeah, it is. But since the start of the year, it's just flat, 0.24, nothing,
hmm.
nothing burger.
Well, China is struggling right now. Their economy is growing slower than expected, and there's
Exactly.
a massive amount of unemployed young Chinese in that country right now. So they lowered some of their borrowing rate to stimulate some of this economic slowdown that they're experiencing. But the U.S. market is unbelievably strong.
Yeah. The Bloomberg article even highlighted the one of the Wall Street bears who called last year's correction bear market successfully, which is Morgan Stanley's Mike Wilson. He did say that the S&P 500 would hit fresh lows at this point in time. But look at where
Mhm.
we are. We're at the highest for the past 12 months, which is really the contrarian move.
Yeah, and this is just in the recent week and a half, I think,
Mhm.
that it really rallied.
Yeah, all of this is bad news for professionals who, according to Bank of America survey, cut their exposure to US stocks to a 17-year low at the start of 2023. So a lot of professional fund managers missed this rally for sure. A lot of money in the sidelines, actually.
Mhm.
So I guess it pays us well, Huawei, to just keep a little bit of exposure to the stock market, not regardless what's happening globally, right?
Well, I've been fortunate enough to benefit from the rally because I've been putting more while I think that the market was not enthusiastic enough. And now that it's ramping up, I'm kind of holding up on buying to see if this, well, like you said, the RSI is high, so most likely we'll see a downtrend tomorrow.
Mm-hmm.
But so far, I think the market is still very rational in its reaction. Because I myself, was expecting things to go down when they said that they were not gonna pause and then raise the the interest rate, and then come to find out they did pause, and now it rallied again today.
Right. Oh well. I think it's all for the better.
Yeah,
According to a Bank of America survey that we shared in the group recently, if we keep going at this rate now that we're in a bull market, we can see a positive return in the stock market for another 53 months. So, if anything, that's definitely a bullish case right now. 53
yeah,
months
something to think
divided by
about.
12, that's going to be for another 4 years that we're going to be in an uptrend. So, Better think about positioning very well. Make sure that you are exposed to the companies that you really like and you think that would survive for the long term.
Yeah, so just like last year, energy led, the fundamental rankings, and now it's showing a downtrend. You may find, those bargains on energy and financials while they're down. Then when it starts really ramping up, you should expect energy to go back up
Right.
along with materials.
Mm-hmm. All right. Well, I guess that does it for this week's recording. Uh,
Yes.
I appreciate you
Can you
coming
believe
in.
it's already Thursday and it's in the middle of the month? Second quarter is almost over.
Exactly. Sooner or later, we're again in a new rate hike. So we'll see how the market reacts at that time.
Yes, Mark. Yep.
All right. Well, I guess that does it for today's episode. Catch us again next week. Thank you
hmm
again, Wally, for making the time and effort to join us.
Yeah,
Um,
well, thank you. Thank you, Mark.
yes, again, well, this is Mark Yu signing out.
And this is Wabi Santos. Like and subscribe, listeners. Thank you.
Thank you.